Have you ever wondered why the stock market and cryptocurrencies seem to be on a roller coaster ride of ups and downs? This thrill ride, my friends, is due to something we call volatility in financial markets. Picture it as the frequency and severity of price swings within these markets. It's like a heartbeat of sorts, pulsating, reacting to economic, political, and social triggers. But what makes these heartbeats so erratic? To understand this, we need to delve into the world of stock markets and cryptocurrencies. Firstly, let's turn our attention to the stock market. The stock market, much like the ocean, is an entity of constant ebb and flow. It can be calm and serene one moment, only to transform into a tempest the very next. This volatility is a result of a multitude of factors, each playing their part in shaping the market's narrative. Consider economic indicators. These are the pulse of a country's economic health. Things like employment rates, inflation figures, and GDP growth. When these indicators show signs of distress, the stock market reacts, often dramatically. Think back to the Great Recession of 2008. A collapse in the housing market sent shockwaves through the economy, and the stock market plummeted in response. Political events too hold sway over the stock market. Elections, policy changes, trade wars, they all have the potential to unsettle investors and trigger market fluctuations. Remember the uncertainty surrounding the Brexit vote in 2016? The mere prospect of the UK leaving the EU sent stocks into a tailspin. Company news is another critical factor. Earnings reports, new product launches, CEO changes, these can all cause stock prices to swing wildly. A classic example is when Apple first announced the iPhone in 2007. The news sent Apple's stock soaring, while competitors' stocks took a hit. Lastly, we have market sentiment. This is the collective mood of investors, driven by their perceptions, emotions, and expectations. It's the reason why stocks sometimes rise or fall for seemingly no reason at all. For instance, during the dot-com bubble of the late 90s, investor euphoria drove tech stocks to dizzying heights, only for them to crash when the bubble burst. So, as you can see, the stock market is not for the faint-hearted. It's a storm that can be as rewarding as it is punishing. A tempest of economic indicators, political events, company news, and market sentiment. But for those who can weather it, the potential for gain is immense. Now let's switch gears and talk about cryptocurrencies. Picture a roller coaster. It's exhilarating, heart-pounding, and perhaps a bit nerve-wracking. That's the world of cryptocurrencies for you. The highs are sky-high and the lows can be, well, pretty low. And what makes this ride so unpredictable? A number of factors, really. Let's start with regulatory news. Governments around the world are still figuring out how to deal with cryptocurrencies. When a country like China announces a new policy on crypto, it can send prices spiraling. Remember back in 2017 when China banned initial coin offerings, or ICOs? Bitcoin's price took a nosedive. Then there's the impact of technological advancements. In this rapidly evolving space, a single breakthrough can lead to massive price swings. Remember the Ethereum network's upgrade to Ethereum 2.0? That sent Ethereum's price soaring as it promised increased scalability and efficiency. Market sentiment also plays a huge role. Cryptocurrencies are driven largely by hype and speculation. When Elon Musk tweets about Dogecoin, it can send the price through the roof. Conversely, negative sentiment can trigger a sell-off, causing prices to plummet. Lastly, there's the age-old principle of supply and demand. Some cryptocurrencies have a cap on their total supply, like Bitcoin's 21 million. When demand outpaces supply, prices rise. Conversely, when supply overshadows demand, prices fall. And let's not forget the infamous Bitcoin crash in 2018, when it fell from nearly $20,000 to just over $3,000 in less than a year. Or the more recent bull run in 2020, when Bitcoin's price shot up from roughly $10,000 to over $60,000 in less than a year. These examples illustrate the extreme volatility in the crypto market. It's a wild ride that can lead to massive gains for those who can stomach the risks. But it's not for the faint of heart. It's a market characterized by rapid price swings and unpredictability. Clearly, cryptocurrencies can provide a thrilling ride, but they can also lead to significant losses. So buckle up and keep your hands inside the vehicle at all times. You're in for a ride. Now that we've looked at both the stock market and cryptocurrencies, how do they compare? Well, let's dive into it. Both the stock market and the crypto market are known for their volatility, but there are some key differences. The stock market, being a mature market, has been around for centuries and has a history of weathering volatility. It's also subject to stringent regulatory oversight by governing bodies who work tirelessly to ensure a level playing field and to protect investors. Cryptocurrencies, on the other hand, are a relatively new kid on the block. They've been around for just over a decade and are still finding their feet. Their volatility is often seen as a result of this immaturity, as the market is still figuring out their true value. What's more, the regulatory environment for cryptocurrencies is less clear, and in many ways, they still operate in a wild west of sorts, where the rules are still being written. And then there's the role of institutional investors. In the stock market, these big players can often stabilize prices, or at least make movements more predictable. In the crypto world, however, their influence is less pronounced, as the market is still largely dominated by individual retail investors. So, while both markets can be volatile, they each have unique characteristics that can make them more or less attractive to different types of investors. It all comes down to your risk tolerance, investment goals, and your belief in the future of these markets. While both markets can be volatile, they each have unique characteristics that can make them more or less attractive to different types of investors. In conclusion, volatility is a fundamental aspect of both the stock market and the world of crypto. We've journeyed through the stormy seas of the stock market and braved the roller coaster ride of cryptocurrencies. In both realms, we've seen how factors such as market sentiment, economic indicators, and regulatory news can whip up waves of volatility. In the stock market, corporate earnings reports, geopolitical events, and changes in economic policy can trigger tremors. In the crypto world, the volatility can be even more pronounced, driven by technological developments, regulatory shifts, and sometimes the sheer unpredictability of a still maturing market. And yet, this volatility isn't necessarily a bad thing. For those with a keen eye and a steady hand, it can offer opportunities to buy low and sell high. Whether you choose to invest in the stock market, cryptocurrencies, or both, remember that understanding volatility is key to managing risk and making informed investment decisions.